In this video, I am going to analyze Larsen & Toubro, which is into realty sector, construction and so on. The current market price of Larsen & Toubro is 1,524 rupees, and we are going to compare L&T with other peer group companies like Engineers India, Ashoka Buildcon, Techno Electric Engineering and GVK Infra. This is going to be an interesting video as we will learn what kind of red flags can be seen through ratios or what kind of problems can very easily be detected through looking at ratios in the companies. This particular sector, realty sector, is going through a turmoil and there are a lot of problems in this particular sector. So let us look at the ratios. The Larsen & Toubro is down from its 52-week high by 5.15%. So it's not fallen much from its highest point or its 52-week high. Compared to other companies, Engineers India has fallen 14%. The highest company which had a fall from its 52-week high was GVK Infra at 30%. Followed by Ashoka Buildcon at 26%. So we can look at this particular percentage and time our entry depending on how much the stock has fallen from its high, provided the other ratios are alright, other fundamental ratios are intact. Earning per share of L&T was 61 rupees per share, and other group companies had Techno Electric had 16 rupees per share of earnings, and Engineers India had 5 rupee 8 paise of earnings per share. The other two companies, Ashoka Buildcon and GMR, didn't have any earning values because they had a loss in the latest years. The latest year would be 2019. The data included in this analysis is up to March 2019. Let us look at the EPS yield. EPS yield measures what is the return at the current market price, how much the company earned in the last year that we have data available for. So on 1,524, the company earned 61 rupees behind every share. That is a 4% yield or 4% earning on the current market price. Looking at the other companies, the highest yield was by Techno Electric. On a 255 rupee share, it has earned, or per share earning was 16 rupees, which roughly translates to 6.46%. Engineers India was 4.93% and EPS yield of L&T was 4.06%. The other two group companies don't have any EPS yield because there is no EPS. As I mentioned earlier, the company had losses in the previous year. The higher the EPS yield, the better it is. Let us move on to the 5 years historical price earning and 3 years historical price earning data, and then we'll look at the latest price earning data as well. So coming back to 5 years historical price earning, this is where the price has been in the last 5 years on average when compared to its earnings. The stock was trading, L&T stock was trading at 25 times its earnings since last 5 years on average, whereas in last 3 years on average it has been trading at 27 times. So it has been always expensive since 5 years and even since last 3 years. It has been trading about 25 times, which is our benchmark value. So we want to enter into a company when the price to earning is below 25 times. Looking at the peer group companies, Engineers India is at 21 times 5 years historical PE and 25 times historical 3 years price earning. Ashoka Buildcon added 20 times 5 years PE and 3 years historical PE was at 36 times. So this is expensive. Techno Electric didn't have any price earning because there was no earning. so we won't have any data here, or we don't have the data available for Techno Electric. GMR Infra's 5 years historical price earning was at 1149 times. This is very high because the price has fallen, but the company had a loss in the last year, or in the latest year they had a loss. Their NPM loss was 15%, whereas Ashoka Buildcon had a 3% net loss percentage. Historically, 5 years price earning, the cheapest one available was Ashoka Buildcon. It was trading at 20 times its price to earnings ratio, and the most expensive was GMR Infra at 1149 times. In 3 years historical price earning, the most economical was Engineers India, available at 25.19 times, and the most expensive was Ashoka Buildcon at 36 times its earnings. Looking at the current price earnings, the Larsen Toubro was trading below 25 times at 24.62 times. The current price was 24 times, or is 24 times higher than its earnings, whereas Engineers India is trading currently at 20 times, and Techno Electric Engineer is available at 15 times. The data for the other two companies is not available. At the current price earning, Techno Electric is only available at 15.4 times, so that is the cheapest stock available, and the most expensive at current price earning is Larsen Toubro. Moving on to the current market price to the OCF comparison, that is the operating cash flow. Larsen Toubro's price to OCF was negative 21 times. Here, investors should look for a positive number and below 25 times. A negative OCF signifies that the company has not earned anything in cash. In fact, it has spent more in their operating activity, other than instead of getting money, cash into the company has spent in their own operations. So this is never a good sign. So we should look for a positive number. Engineers India price to OCF was a very good 12 times. At the current cash earnings, it was only available at 12 times. Ashoka Buildcon's price is currently trading only 3 times more than its cash earnings, which is again very good. Techno Electric's price to cash ratio is at 13 times, and GMR is trading at only 3.86 times. This does not necessarily mean that it's a good company just because the price to OCF is low. We need to cross compare it with other numbers to understand where the overall company's fundamentals are. The best available price to OCF is for Techno Electric at 3.86 times. Ashoka Buildcon at 3.86 times and GMR at 3.86 times. We'll move on to the comparison of price compared to its book value. Book value stands for the net worth of the company per share. How much the company has declared that its shares are worth. The book value is calculated by removing all assets and paying off all liabilities, and the balance that remains with the company is distributed to the shareholders. That is the net worth of the company. So currently, L&T is trading at 3.43 times its book value. Engineers India is also trading at 3.3 times. Ashoka Buildcon is very expensive at 12.4 times. Techno Electric is trading at 2 times. And GMR, we don't have any data here. So the price to book value should be below 2.5 times. All the companies except Techno Electric is trading below 2.5 times. They're all very expensive. So the most cheapest one in terms of price to book comparison is Techno Electric Engineering, available at 2 times its book value, and the most expensive is Ashoka Buildcon at 12 times its book value. Definitely we have to avoid Ashoka Buildcon because it's way too expensive and it needs to fall. The price needs to come down or the book value needs to go up so that the price to book value falls below 2.5. Most of these companies are trading at a premium. Moving on to the PEG of 5 years and PEG of last 3 years, and looking at the profit growth rate of 5 years and 3 years compared with the price earning of the latest year. These 5 ratios will be looked together because they are all connected with each other. So the PEG stands for price earnings to profit growth for the last 5 years, and price earning to profit growth rate comparison of last 3 years. With this comparison, what we understand is, although we are paying 24 times, and if there is a growth in the earnings, then we'll be able to recover our initial capital much faster. Instead of waiting for 24 times, we have to wait for less number of years to recover our initial capital. The PEG has to be below 1.5 times, which signifies that we are buying at a reasonable level when comparing the price earning. So for PEG of 5 years, we take the price earning of 24 times and divide that by the profit growth of the last 5 years. So 24 divided by 13, we get 1.7, and PEG of last 3 years is calculated by dividing the price earning 24 by the profit growth rate of 27%. So we get a PEG of 0.9 times. Now what here we need to understand is that the PEG has to be between 0 and less than 1.5 times, which signifies that we will be able to recover our initial capital much faster. Looking at the profit growth rate of 5 years, the company has been growing its profit from 5 years back at the rate of 13%, and its profit in the last 3 years has increased even faster at the rate of 27%. So the company is growing its profit at a fast rate of 27%. Now when we look at these 4 numbers together, we see a healthy growth rate in profit as well as faster recovery of our initial capital if it is invested in this company. Looking at the other companies, the PEG of Engineers India is negative because there was a degrowth in profit from 5 years back at the rate of 8.8%, but in the last 3 years the growth has picked up and the profit has grown at the rate of 11.98%. The PEG therefore stands at negative minus 2.2. As I mentioned, we should see a PEG between 0 and 1.5, less than 1.5, and in the last 3 years the PEG has recovered to 1.6 times. The other companies like Ashoka Buildcon does not have the available profit growth rates, therefore we wouldn't get the PEG as well. Techno Electric has only PEG of 3 years, which is 0.17, so this is good as it is below 1.5 times, and the profit has grown at a very fast rate of 93%. Whenever we see a very high growth rate in profit like 93%, this has to be rechecked why it is growing at such a high rate, or what is the reason behind the growth rate being 93%. Is that because 3 years back the profit was way too less and now the profit in terms of that 3 years back profit has grown at a high rate? So here we are paying 15 times but we are getting a growth rate of 93%. So the lower the number, the closer it is to 0, the faster we'll be able to recover our capital. And GMR Infra, last 5 years, it has been growing its profit at the rate of 17%. But in the recent 3 years, the profit was falling at the rate of 14%. So the 5 years value is okay, but last 3 years there has been a fall in profit of the company. And we don't have the PEG ratio because we don't have the price earning for this company, as the company had suffered losses in the latest year. Same is the case for Ashoka Buildcon, where it has suffered a loss and therefore we don't have the price earning of that company. Let us understand the ratings for these companies. For PEG 5 years, the best one was L&T at 1.7 times. Even though it is above 1.5 times, that is our benchmark, but it is still the best in the peer group company, and the only data that we have available for is L&T. And Engineers India had a negative PEG ratio. For the PEG of last 3 years, the best one in the group was of Techno Electric, available at 0.17 times, and Engineers India was having a PEG of 1.69, which was above 1.5, so that's the worst performing. Larsen Toubro's PEG of last 3 years was 0.9, which is a good value. Looking at the profit growth rate, the fastest growth rate was in GMR Infra at the rate of 17%, and the profit growth rate of L&T was 13%, and Engineers India had a degrowth of minus 8.8% in the last 5 years. As for the profit growth in last 3 years, Larsen Toubro had increased its profit at the rate of 27%, and Engineers India had grown its profit at the rate of 11.98%. GMR had a degrowth in its profit in the last 3 years. Let us check the sales growth rate of the last 5 years and the sales growth rate in the last 3 years. L&T had a sales growth rate of 9.9% since 5 years back, and from 3 years back it had a growth rate of 9.19%. We should look for at least above 10% growth rate in sales every year on average. Engineers India had a degrowth in sales from 5 years back at the rate of minus 6.53%, although in the last 3 years it has recovered at the rate of 1.43%. Ashoka Buildcon had a double-digit sales growth rate for both 5 years and 3 years, which is a good sign. Techno Electric had above average sales growth rate of 132%. Whenever we see such a value, we have to make double sure why there is a drastic improvement or why there is a sudden spurt in the sales growth rate. GMR Infra had a degrowth in sales from 3 years back at the rate of 7.69%. So in terms of sales growth in the last 5 years and last 3 years, Ashoka Buildcon did the best. It increased its sales at the rate of 14% since 5 years back and 15% since 3 years back. The worst performing were GMR, which had a degrowth. Even Engineers India had a degrowth in its sales for both the 5 years and the last 3 years. Let us check out the return on equity and return on capital employed. Return on equity measures what profit the company earned on shareholders' money, and return on capital employed measures what was the total profit earned by the company on the capital employed by the business. The capital employed is calculated by adding both the shareholders' funds and the outsiders' funds. Outsider funds would include the borrowings from banks, financial institutions, and so on. Return on equity of last 5 years for L&T was 12%. Here the benchmark is 15% and above. So we would like to see an ROE and ROCE of above 15%. Anything below that is considered not good for the company. Engineers India's ROE was 13% and return on capital employed was 20%, much better than L&T's. Ashoka Buildcon's return on equity is negative. So here itself we should not invest in this company because it has been since last 5 years it has not earned anything. Instead, in fact, it is making losses on the shareholders' money, whereas on the capital employed it is earning 11%. GMR is also losing money on the shareholders' funds, whereas on the capital employed it is earning 2.64%. Here itself we should reject these companies, GMR and Ashoka Buildcon both. The moment it goes negative ROE or ROC, it should be removed out from the analysis directly. Regardless of what is the sales growth, how much is the profit growth rate, it doesn't matter. If the return ratios are poor, it means we have to discard those companies out of our analysis. The best performing ROE ratio was for Engineers India at 13.28%, although it is lower than 15%. And ROCE, again, Engineers India was earning the best returns on the total capital employed by the business. Let's move on to the analysis of profit that the company has earned in the last 5 years and compare that with the cash flow from operations. How much of the profit was converted to cash is measured by dividing the cash flow from operations with the profit after tax figure. L&T showed a profit of 27,520 CR in the last 5 years. But its cash flow is negative, meaning nothing is there to show in terms of cash. In fact, it has spent more in the operations of the business. Here, what we expect is that if the company is showing profit, it should get reflected into its cash part as well. But here, we don't see the cash. Over and above that, the company has spent 15,000 CR more in its operations. Now, where did they get the money to spend when the profit itself was just 27,000 CR? So here the company must have borrowed from the market to fund its business operations. We never would want to see a negative cash flow from operations in the business. When we see a negative cash flow, we should avoid these companies completely. Except for banks, which would generally have a negative cash flow from operations. So the cash flow from operations to PAT figure is minus 155%. Here we want at least 0 or more, 100 or more than 100. Meaning everything of the earnings should get reflected into cash, or everything of the earnings and more of that in cash should be there to be reflected in the financial statements. So here for Engineers India, the company's profits were 1,700 CR, against which there was a positive cash flow 1,047 CR. Not everything that the company showed as profit got reflected into cash. The cash component was short by 38%. So out of 1,700 CR, only 1,047 came in through cash. Here too, we don't want more than 30% to be pending out of the profit. Not more than 30% should be pending or not coming out in cash, meaning 70-30 ratio is all right. Whatever the company is showing as profit, 70% of that should come by way of cash and even if 30% is still pending, it's okay. So here too, Engineers India is not doing well. 38% of the profit has not come in as cash. Ashoka Buildcon had a negative profits. If from last 5 years, it has made a total loss of 262 CR, whereas it is showing a cash of 2,868 CR. Now, why is the company showing loss and we have a positive cash flow? Whenever we see these kind of numbers, again we have to be very cautious not to invest in these companies, because there is a lot of manipulation going on into these companies. We want both the figures to be positive, like Engineers India, where 1700 CR of profit was shown and the cash component coming into the business was 1047 CR. Although it is above 30% of the less than 30% of the PAT, but it's still good to have these kind of numbers where both are positive and nearby each other. Same is the case for GMR. Although in last 5 years it has made a total loss of 9200 CR, it is showing that it has a cash of 15,854 CR. Whenever we see these kind of numbers in Ashoka Buildcon, even in GMR, these are to be completely avoided. We should never invest in the companies which have negative PAT and that is having losses since last 5 years, and even cash flow is negative. The only marking that I can give in terms of CFO to PAT comparison is to Engineers India at 38.5% of the profit coming in by way of cash. Only 38.5% of the profit not coming in as cash. Rest all our data is not available. Even in Larsen Toubro has a very bad CFO to PAT comparison. Let us look at the free cash flow. Free cash flow is calculated by removing out all the cash and non-cash expenditures incurred in the operations of the business as well as in the investment activity of the business. So here we want that the free cash flow to remain around 50% of the cash flow from operations. So the company first of all had a L&T company had a negative cash flow from operations. Over and above that, they had an excess investments done. Therefore, they had a negative free cash flow. Here too, we would want to definitely see a positive free cash flow value, and that too, it should be more than 50% of the cash flow from operations. So we see a negative value here. This itself means we should not invest in this kind of companies. Engineers India had 829 CR of free cash flow, which is 20% less than its cash flow from operations. In the last 5 years, it had received a cash of 1047 CR and it still has 829 CR of free cash with it. So that is just a 20% shortfall. We don't want this to go below 50%. Ashoka Buildcons had a cash of 2,868 CR, whereas the free cash flow is just 501 CR. That is why earlier I said that if the PAT is negative and there is excess cash, then that does not mean that the company is good. Then we have to see the free cash flow. The free cash flow is 82% less than the cash flow from operations, just 501 CR. So this is not a good sign again. Moving on to the GMR. The GMR's cash was 15,854 CR, whereas its actual free cash flow was just 3,060 CR, which is 80% less than the cash flow from operations. These are not good ratios and we should avoid these kind of companies. In this analysis, only Engineers India gets 5 marks because it has managed to keep its free cash flow at less than 50% of its cash flow from operations. Let us look at the 1-year picture of the profit and the cash flow. Here, first we will compare the profit of the current year or the latest year with its average of the last 5 years, and then we will look at the cash flow from operations of the last year with the profit that the company has earned. So we'll look at the profit to average profit comparison first. The Larsen Toubro's latest profit was 8,768 CR, which was 59% above the average PAT. So the average PAT was 5 years for 5 years was 5,500, and the latest year it earned 8,700, which was 59% above the average. So this is a good sign. But as I said earlier, the free cash flow is negative. We should completely avoid Larsen Toubro. I'm not sure why the company is getting such high valuations even now. Let us look at the other valuations for other companies. We'll also first compare the cash flow. Even in the latest year, L&T had a negative cash flow from operations of 10,000 CR, whereas it showed a profit of 8,768 CR. This is again not a very good sign. So the CFO to PAT is negative 214%. That is, the company showed a profit of 8,700, but there was nothing to be shown in terms of cash. In fact, excess money went into its operating activity. That was 214 times more than what it earned in profit. Engineers India cash to PAT was 55%. That is, the latest year's profit was 377 CR and its cash from operations was 587 CR. So it was 55% more than its profit figure. This is what we want to see, that the cash flow from operations is getting reflected when the company is showing what its earnings are. So this is a good value. Last year too, Ashoka Buildcon had a loss of 119 CR, but it showed a cash of 1015 CR. So we cannot take this as a proper value, as we saw in the last 5 years how free cash flow was just 82% of the cash from operations. Similarly, in the latest year too, the company has shown a positive cash flow but a negative PAT. If anyone can suggest in the comment section why L&T is getting such high premium and valuation, also why Ashoka Buildcon is being bought by investors, they can comment if I have not explained this thing correctly. Techno Electric engineer had 5.9% more than its earning coming in by way of cash. Of the 200 CR earned last year, the company's cash was 212 CR, which is 5.9% more than its earnings. GMR had a loss of 1,500 CR last year, whereas it showed a profit of 2,347 CR. GMR Infra is a completely gone company. It has no value in its stock, and the ratios are very similar to L&T, but still L&T is getting a very high premium, very high valuation. So I am not able to understand why I would want to invest in L&T when I wouldn't invest in a company like GMR. Here too, only Engineers India did well in terms of latest year's cash comparison with its earnings. So 55% more than the earnings has come in by way of cash. Let us look at the quarterly sales growth year on year of March 2019 with March 2018. and then look at the profit growth rate as well, YOY. The company's sales, L&T's sales has increased YOY, that is March over March, by 10%, and the profit has increased by 7.92%. This is a good metric. We have to look for a value above 10%. Engineers India has grown its sales by 20% and its profit by 37%. So these are very good values for the latest quarter. No data is available for Ashoka Buildcon. Let us look at Techno Electric. Although its sales fell by 42%, it is showing a profit growth rate of 15%. Again, we have to understand when the sales are dropping, why is the profit increasing? Or if the sales are increasing, why is the profit dropping? So we have to ask a question, what is wrong in the company that it is the two numbers are moving away from each other. When the sales are increasing, we should expect the profit should increase and vice versa. And if the profit is increasing, the sales should be increasing. When one of the two ratios are not in order, it means we have to be alert and look for variations and find out where the problem is there. Possibly we should avoid such kind of companies where there is a huge variation, where at one place it's saying the sales has fallen at the rate of 42%, yet the profit is growing. GMR sales has dropped by 6%, whereas the profit has fallen by 2,747%. That is, this company is anyways out of the analysis. Ashoka Buildcon is also out. We have to look at the other companies where our ROE, ROC was very less. So what we had initially checked, even Ashoka Buildcon has to go out of our analysis because ROE, ROC are extremely bad. GMR ROC is negative. There is no ROE is negative and there is no ROCE at all. Let us continue looking at the quarterly sales growth and profit growth rate. Of the peer group companies, Engineers India has done the best in terms of growing its sales quarter over quarter, and even the profit has grown the best in the peer group companies. Let us move on to the net worth to contingent liability comparison. Net worth is the actual value of the company when the company pays off all its liabilities by selling all its assets. So L&T is still worth 62,374 crores. As of today, if the company still sells all its assets and pays off all the liabilities, it would still have an excess cash of 62,374 crores with it to be distributed to the shareholders. So in the peer group, Larsen Toubro is the largest company. Engineers India is a 2,200 CR company. Ashoka Buildcon is a small cap at 315 CR. Techno Electric is 1,400 CR of net worth. GMR has a negative net worth. Again, here we have to be very careful that the worth doesn't turn negative. It means even if they sell all their assets, they won't be able to pay those liabilities with their assets. So here itself, this company goes away. This has to be crossed out. So every time a ratio goes out of its range, you have to totally ignore those kind of companies. A negative net worth company should never be invested in. Let us look at the contingent liability, the liability which may or may not arise in the future, but for which provisions are not done. So we want to make sure that the contingent liability doesn't exceed 20% of the net worth. If it exceeds, then there is possibility that the company may have to pay that liability if it arises. Larsen Toubro has 34% contingent liability standing against its net worth. So its net worth is 62,000 CR, whereas its contingent liability stands at 21,000 CR. This is above 20%, which is not a good sign. Engineer India's contingent liability stands at a very high 56%. So its net worth is 2200 CR, but its contingent liability is 1280 CR, which is very high. Ashoka Buildcon's contingent liability is 5.4 times higher than its net worth. Completely avoidable. Techno Electric's contingent liability is just 3.2% of its net worth. So most of these companies have very bad ratios. So in terms of contingent liability to net worth, only Techno Electric Engineer has done the best. It has the least amount of contingent liability against its net worth. Let us look at the debt to equity comparison and debt to equity ratio. The debt to equity ratio should not exceed more than 1 times. That is, debt should not be more than the equity contribution by the shareholders. Larsen Toubro has a debt of 1.6 times, which is very high when compared to its equity. Engineer India doesn't have any debt. Ashoka Buildcon's debt is way too high at 16 times. Techno Electric's engineer's debt is just 0.01 times. That is hardly anything. So what we see here is whenever the debt exceeds 1 times, it directly affects the company's profitability ratio. It has to pay more interest if the debt increases. So we can see here clearly that when the debt has increased by more than 1 times, its coverage has fallen below 4 times. Now it stands at 2.5 times. So interest coverage basically tells us how much this year's net profit can cover future years' interest payments. So only for next 2.5 years can this year's profit accommodate the future interest payments. Looking at Engineers India, we can see since it had no debt, it has a very good coverage. It doesn't have to pay any interest. Whatever is earned goes to the shareholders as profit. Ashoka Buildcon's debt to equity is extremely screwed up. It is 16 times. Therefore, it wouldn't have any coverage at all at 0.96 times, just 0.96 years. That is not even 1 year's interest it can cover with the current debt to equity ratio. This is completely out. Ashoka Buildcon is not to be invested in. GMR is not to be invested in. And as we move on, we can see even Larsen Toubro is out of the question for investment. As far as what I understand, Larsen Toubro has always been a blue chip company, but when looking at the pure fundamental data, it doesn't look like a blue chip company. Any day, anytime, it may fall. I'm not sure why it is still stuck at such high valuations. Similarly, if you see Techno Electric doesn't have any debt, therefore it has a high interest coverage. So in terms of debt to equity, Engineer India has done the best. Also, it has a very high coverage since it has no debt. Let us look at the promoter holding. The higher the promoter holding, the better it is. We don't have the promoter holding data and the pledge share percentage for L&T. Engineer India's promoters hold 52%. Ashoka Buildcon's promoters hold 54%. Techno Electric Engineers promoters hold 58%. And GMR Infra promoters hold 63%. Just because the promoter holding is high, it is no guarantee that the company promoter will continue running the business in the best possible manner. As we can see, GMR has been totally screwed up in terms of ratios. It has a negative net worth, no coverage, nothing. In fact, even a high promoter holding in Ashoka Buildcon is no guarantee. They have taken 16 times higher debt than its equity contribution. There is no coverage in the company. interest coverage is nil. So just because the promoters have a high holding is no guarantee that the company is in good hands, or the promoters will look after the shareholders' interest. Let us look at the pledge share. None of the companies have pledged except GMR Infra. The promoters have pledged 83% of their shareholding, meaning they are completely out. They have given their shares to the banks as collateral, and if they don't release that, the banks will sell off those pledged shares and the price will fall. As we saw earlier, the price has just come to 15 rupees now. So these kind of companies have to be totally avoided by looking at these core ratios. Just by looking at these 34 ratios, we can get a very good idea as to how the company is doing. Besides these ratios, we can look at more ratios if you would want to in detail on different websites. This data has been sourced from screener.in website, and I have converted this into Excel sheet so that I can add a few more ratios to the existing one, and it is more presentable. Since none of the companies have pledged any shares except GMR, I'm not giving any score to any of the companies. Let us look at the debtors to sales percentage. This ratio measures what is the amount of accounts receivable pending to be collected this year against this year's sales. So out of the total sales done this year, how much is still pending to be collected from the total debtors or the accounts receivable? The total debtors to sales percentage should not exceed 30%. Whenever it exceeds 30%, it shows that the company has sold, but its sales has no value because it has not received money against those sales, or that much amount of debtors are still pending to be collected. So for example, if the company has a sale of 100 CR and the accounts receivable is showing 70 CR, so out of 100, 70 has not come in. 70 CR has not come in. Only 30 CR of the sales has come in, and 70 CR is still pending to be collected. So what is the use of that sales? You can show 1000 CR of sales, but if the customers' payments are not coming in, it's of no use. That sale is of no use. So we want the debtors to sales percentage to be below 30%. Larsen Toubro has managed to remain below 30. Engineers India is at 16%. Only 16% of the debtors are to be collected. Ashoka Buildcon has 19%. Now since Ashoka Buildcon is out of the question, even GMR is out of the question, we won't give any marking to these companies. Let us continue looking at the other ratios. Techno Electric's debtor to sales is very high at 55%, meaning this year's sales against this year's sales, 55% of that sales is still to be collected from the customers. This is never a good sign, because money not coming into the business is opportunity lost. The company has to borrow more and more and more, and that's a trap, a perpetual trap for the company. GMR is again out of the question because we are not analyzing it any further. Although it's only 19% of the debtors are there, but it doesn't have any sales, and its net worth is negative. So what is there to analyze in this company? Let us look in how many days these companies are collecting money from its customers. L&T is collecting payment within 105 days. Here the benchmark is 90 days. That is, within 3 months the company has to collect payment from its customers. 90 days is a long period that a company can give to its customers to receive payment from them. Anything above 90 days is risky because customers may default on their payment. Unless and until these companies are also getting credit period, like how they give their customers time to pay them the companies would also receive time to pay money to whomsoever they have bought goods from. Engineer India is taking 111 days to collect payment from its customers. The good thing about Engineers India is that the debtors to sales is very low at 16%. Ashoka Buildcon is taking 69 days, Techno Electric is taking 215 days, and GMR is receiving money in 74 days. So in terms of debtors to sales, Engineer India has done well by keeping its debtors at 16% of its sales. And it is collecting payment from its customers at 111 days, within 111 days. Let us look at the net profit margin of the companies in the latest year, that is March 2019. As we can see, Engineers India has done very well and has earned 21% net profit margin in the latest year. So it gets the full marks. Techno Electric has earned 15%. Anything above 10% is good. And L&T has done lower than 10%. GMR had a net loss of 15%. Even Ashoka Buildcon had a net loss of 3%. Now why we avoided Ashoka Buildcon I have already explained. Very high debt of 16 times. Totally avoidable. Interest coverage is very low. The previous values were also not very good. It had a negative free cash flow. Completely avoidable. You don't want negative free cash flow in the company. Most of these companies have some or the other issue, and it's best to avoid these kind of companies. Let us look at the dividend yield. The highest dividend yield was provided by Engineers India at 3.3%, and L&T is providing a dividend yield of 1%. So this concludes our analysis. The highest score is of course Engineers India at 104 points, and close by is L&T. Rest all other companies are completely avoidable. In fact, even L&T is completely avoidable because its cash flow from operations is negative for last 5 years. Completely avoidable. Even its free cash flow is negative. If you look at Engineers India free cash flow, that is still good at 829 CR. Numbers are much better for Engineers India. This is the only company that looks as investable in the group. Do comment if you find mistakes in this analysis and let me know if something needs to be corrected. Thank you for watching this video.